Markets remain highly concentrated, yet the most recent quarter showed us early signs of a broader set of winners. So how should advisors think about that shift? Hi, I'm Ryan Barksdale. In today's video, I'll walk through what drove markets in the second quarter, how that concentration and dispersion is shaping risks and opportunities, and how advisors can position portfolios to balance indexing as a core with selective active exposure. Q2 was a strong rebound, but not a simple everything rally. Global equities rose sharply, with the S&P 500 up about 15%, its best quarter since 2020, and the MSCI World up roughly 14%. But leadership was uneven. Emerging markets outperformed meaningfully, up about 24% for the quarter, more than 14 percentage points ahead of developed markets, with Korea a standout driven by the AI and semiconductor supply chain. Under the surface, momentum and AI-linked stocks drove returns. U.S. momentum was up more than 40% in the quarter. Semiconductors and industrials led, while energy lagged as oil prices pulled back. At the same time, we did start to see early signs of broadening, with small caps and micro caps outperforming large caps. So for advisors, the key takeaway is this: portfolios likely benefited from the rally, but many clients may still be more exposed than they realize to a narrow set of AI-driven outcomes. This is a good moment to reassess diversification. Right now, two things are happening at the same time. The market is still highly concentrated. A relatively small group of AI-linked companies is driving a disproportionate share of earnings. By some estimates, roughly 15 companies could account for about 30% of global earnings and more than half of earnings growth this year. At the same time, dispersion is rising across sectors, regions, and individual stocks, meaning the gap between winners and losers is widening. That combination matters. Passive exposure will still work well as a core, but today's index may be more tied to a narrow set of outcomes than many clients may realize. Active management can complement that by underwriting companies one by one, where fundamentals, expectations, and valuations are diverging. This is very actionable for advisors. It's about helping clients understand what they own, where risks are concentrated, and where adding selectivity can improve portfolio balance. The first phase of AI was about the initial beneficiaries: chips, cloud, and the mega cap platforms. What we're seeing now is the next phase. It's broader and more physical: power, data centers, cooling, memory, and networking, along with infrastructure software and cybersecurity. But the key shift is this: the question is no longer just who benefits from AI spending, it's really who can monetize it. The scale of investment is enormous. AI-related CapEx is expected to reach roughly $800 billion this year, with cumulative investment potentially exceeding $5 trillion by the end of the decade. So the real debate is whether that investment translates into productivity gains, earnings growth, and returns on capital. For advisors and clients, that means the opportunity set is expanding, but it's also becoming more selective. This is where fundamentals and business models really matter. I'd frame this less as a clean shift from growth to value and more as a gradual broadening of the opportunity set. Earlier this year, we saw a rotation into value, small caps, and more cyclical areas. In Q2, growth reasserted itself as the AI cycle accelerated. But underneath that, earnings momentum is starting to broaden. It's also important to remember that new technologies take time to diffuse. Even with something as powerful as AI, adoption tends to be uneven, with bottlenecks that slow how quickly productivity gains show up across the economy. So for advisors, the implication is this is a more balanced market environment. That creates more ways to add value, not by making a single style call, but by being selective across sectors, regions, and companies. I think it's important to start with what hasn't changed. Indexing remains a powerful foundation for portfolios for very consistent reasons: low cost, broad diversification, and reliable market exposure. For most clients, that should continue to serve as the core. What has changed is the backdrop. Markets are more concentrated and dispersion is increasing. That creates a clearer role for active, especially where talent and cost discipline can make a difference. In this environment, active is about understanding where AI-driven expectations are justified, where they may be too optimistic, and where opportunities exist beyond the narrow group of stocks driving broad market returns. The practical takeaway for advisors is to keep indexing as the core, but be intentional about where active can add value, particularly where selectivity and skilled management can improve client outcomes. Be sure to like this video and subscribe to this channel to hear more from Vanguard's thought leaders.